Welcome to The Explainer. Today, we're going to do something kind of cool. We're taking one single decision from just one bank in one country and using it to show you the powerful forces that are shaping our entire global economy right now.
So let's set the scene. January 29, 2026. The South African Reserve Bank makes a choice. Now, on the surface, it seems totally local, right? But it's actually a perfect snapshot of this massive global economic tug-of-war that pretty much every country is caught in.
So you're probably wondering, how can one little announcement act like a magnifying glass for the whole world economy? Well, we're about to see the major currents, both political and economic, that are really pulling the strings on all of our investments.
Okay, first things first, let's set the stage. Because to really get why this one decision matters so much, you have to understand the turbulent, kind of chaotic global environment it was born into. Early 2026 was just defined by serious volatility. I mean, we saw a weaker US dollar, geopolitical fears were really ratcheting up, commodities were swinging wildly, and the big stock markets were looking pretty shaky. This was the nervous, uncertain backdrop every central bank was dealing with. And you can see just how directly global politics were hitting market prices. Just the fear, the mere possibility of a US strike on Iran was enough to push oil over $70 a barrel for the first time in months. It's a perfect example of just how sensitive and jittery the markets are to conflict.
So, with all that chaos swirling in the background, what did the South African Reserve Bank actually decide to do? What was their move?
So the key tool they have is called the repo rate. And don't worry about the name, just think of it as the master interest rate. It's the one that affects everything from car loans to mortgages. So the big question was, what would they do with it? They chose to do absolutely nothing. The South African Reserve Bank, or the SARB as it's known, held its repo rate steady at 6.75%. Now, while most analysts expected this, the real story, as always, is in the details. And this is where you really see the tension. The decision wasn't unanimous, not at all. The committee was split, with 4 members voting to hold, but two actually wanted to cut rates to try and jumpstart the economy. That division tells you just how tough the call really was. The governor's statement really clarifies their whole dilemma. He's pointing out that prices for essentials like electricity and food could spike, which argues for keeping rates steady, but at the very same time, he notes that overall inflation is still under control. It's that classic central banker's balancing act, a real tightrope walk. The decision was expected, so the market reaction should have been simple, right? A big nothing burger? Well, wrong. The market sent some very mixed signals, and this is where the story gets really, really interesting.
So here's the paradox. The country's currency, the rand, got weaker. But at the same time, safer assets like government bonds actually got stronger. And even the stock market ticked up a bit. So how does that make any sense?
Let's put a number on that currency move. The rand slid by about 0.5% to trade around 15.86 against the US dollar. It basically gave back all its earlier gains. And this happened despite the central bank doing exactly what everyone thought it was going to do.
Okay, here's the solution to the puzzle. The crucial point is that the market's reaction wasn't about the local decision. It was about that big, scary global picture. With so much uncertainty out there, investors started a classic flight to quality, which just means they sold riskier assets and bought safer ones, like South African government bonds, even as the currency weakened from those very same global fears. So let's zoom out. This single event, this one day, gives us a playbook for understanding how pretty much all emerging markets are trying to navigate the world right now. And it boils down to 4 key takeaways.
Okay, first, central banks are being extremely cautious. They're not making any sudden moves. Second, local currencies have become hostages to the global mood. It's not just about domestic policy anymore. Third, government bonds are the key safe harbor when fear takes over. And fourth, while inflation is mostly contained for now, you better believe everyone is watching it like a hawk.
So what's the one big overarching theme that this whole thing helps us understand? What's the new rule of the game for investors?
The new rule of the game is this. Markets are being pulled around by 2 giant forces. First, there's geopolitical risk, like the tensions with Iran. And second, there's policy divergence, which is a fancy way of saying there's a growing gap between what central banks in different countries are doing. It means currencies and stocks are now reacting just as much to political headlines as they are to hard economic data.
And that leaves us with the most important question for any investor today.
When the old rules of economics are being overshadowed by politics and central bank conflicts, how do you calibrate your risk? Figuring that out is the most critical skill right now, and it's definitely something to think about.